Welcome to the Investing Show, where we discuss the news that matters to investors and get ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Richard Hunter of Wilson King.
Hi, Simon.
And Nick Batsford of Tip TV.
Simon.
Coming up later on today's show, we've got Gemma Godfrey to talk about whether investing is made too complicated by the investing world and what investors can do about that in order to make a bit more money and make a bit more sense of things. But first, a quick look at some of the things that have been in the news and something from a little while ago, but we'll leave that for later. Richard, what's been going on recently? It's been a long, drawn-out days of summer, hasn't it?
Yes, this could be a short show. We've just been past the traditional quiet summer months, and there's been very little going on in terms of trading activity. Even the headline, I think we've mentioned before, Brexit, Schmexit. There was a bit of a knee-jerk reaction in terms of some of the economic data that we saw coming through in July, but that seems to have bounced back in August. So there's still obviously a long way to go in terms of what the UK is going to do with trade deals and so on, but in terms of the immediate, you might remember just after Brexit, there was a lot of people talking about how we were going to go headlong into a recession. There's no evidence of that at this moment in time. However, what the quietness of a month of August does do is perhaps give you that opportunity to sit back and realise that there are a number of reasons why perhaps you should be considering investing at all. I think a lot of the things that people tend to walk away from is that there's so many uncertainties at the moment. Is this the right time to be getting in? But of course, the impossible thing to do is to be in a position where you're timing the market. What's far more important is your time in the market. If you're taking a longer term view, and again, we've spoken many times about compound interest when you start reinvesting those dividends, really this is quite a benign environment that we're in terms of central banks doing everything they can to put adrenaline in the arms of those economies. We've got interest rates which are low and likely to be for some time, and that equities or shares are already starting to tick some boxes there, not only in terms of your potential for capital return, but of course dividend yield as well. So if you are thinking, and this is really taking a long view, and one of the things that's prompted this is looking decades out when the younger generation are going to be responsible for their own pension come that time. It really is a question now, and I'm sure we'll hear something more about this later in the programme, about becoming rather less afraid around the arcane world of investment and consideration as to how you can start to dip your toe in the water there.
Well, beyond the fact that this year the one thing we didn't have in August was what had become the traditional summer crisis and panic, did we? I think that what's illustrated some of this stuff around trying to time the market and sometimes the art of doing nothing can be the best thing, has actually been Brexit. Because obviously we had, the result of the vote comes through, everyone has a panic, market tumbles. If you'd have jumped out then and thought, right, I'm running for the exit, and you took your money out of your investments, then you'd be looking now at being down substantially on where you could have been if you'd have just sat there, stayed put and ridden out the storm. And of course we could never have predicted that actually things were going to be okay. I think the markets and investments have probably done much better than we would have expected, haven't they? But to the same extent, if we look at the Investment Association figures, there was a huge amount of money pulled out of funds, wasn't there, in the run-up to Brexit and just after Brexit. And that's a classic example of where investors can tend to underperform their own investments because they sell out at the wrong time and they buy in at the wrong time. Yeah,
and there are those that say, of course, will retail investors never learn? Because the fact of the matter is, until you sell your shares, it's just a paper loss. When you sell your shares, it becomes an actual loss. And you're absolutely right. If you look at the day after Brexit, the market opened down 8%. By the end of the day, it was down 3%. In the 4 days leading up to that Friday, it had been up 3%. So over the course of the week, the market was unchanged based on this historic decision that the UK had taken. Even in terms of that week, on a sort of share price graph, it's not going to register because the market was flat for the week. And one of the graphs, again, we've mentioned before, and it is a great graph from the Second World War to present, the general direction of the all-share, where you see that 1987, for example, the crash is just a tiny little V on that line, and even the financial crisis. You can, over that period of time, you can see that something's gone on, but the general direction of travel remains the same. Now, obviously, you've got the inevitable past performance not being any guarantee to future performance. That being said, if you're picking quality companies, if you're reinvesting that dividend income, and in the absence of yield in other investment classes, this could actually be quite a compelling time to be thinking about shares.
And so now that the kids are back at school, the adults are back at work, well, some of us anyway. I've noticed an absence of some people still.
Yeah.
What are we looking forward to over the next month or so? What's coming up? Anything interesting?
Well, I guess the putting the Fed to one side and any potential rate hikes, which now is seems to be off the table for September, maybe we're talking about December. The big sideshow, and it's going to be a big sideshow, is going to be the US election. In the interim, you've got this G20 meeting, which doesn't normally come out the other side with too much concrete being agreed. As a kind of adjunct to that, however, we've had this potential agreement between Russia and Saudi Arabia, which has obviously been good for the oil price. But I think the US election is now one of those big events that we need to be getting out of the way, because how the market reacts and how indeed the economy is subsequently going to react is very much going to depend on which one of those two ultimately gets into power.
Ultimately could be a bigger result than Brexit, perhaps.
Indeed.
Well, there's the thought.
Yeah. So, in the spirit of thinking long term, my good friend, Mr. Nick Basford, has decided to think very, very long term indeed. In fact, cast your mind back to the 1920s, is that correct?
Well, this individual we're going to talk about lived from 1877 to 1940. The Reminiscence of a Stock Operator, excuse me, a book that I guess leads a huge amount of people into the stock markets. I've probably read this 10 times, so if you think about sort of trading and markets, this is my tip of the day. Bit of background about this individual. This young man ran away from home to escape a life of farming at the age of 15, having earned profits of over $1,000, which was a huge amount of money in the 1890s. He would regularly beat the bucket shops, which I guess was a sort of term for a stockbroker, if that's the right word, and was eventually banned from them because he was making so much money. He owned a series of mansions around the world, each fully staffed with servants, a fleet of limousines and yachts for trips to Europe. So he really was the Warren Buffett of this period of time. In 1907, there was a stock market crash. He was worth $3 million, and then basically lost 90% of his money, and was declared bankrupt. Then in 1929, he noticed market conditions were changing, and basically, at the end of the crash, was thought to be worth $100 million.
Which was a huge...
Which was just a ridiculous amount of money, because he was basically short-selling everything. But he did die, he committed suicide.
And the book, Reminiscences of a Stock Operator, is theoretically written by this guy, Edwin Lefebvre, isn't it?
Yep.
But it's actually about Jesse Livermore, who was the trader.
Absolutely.
And it's judged to be sort of his thinly disguised autobiography, isn't it?
Yep.
And it really is, I mean, it explains a lot, actually, I think, about what happened in the 20s and stuff. Things like the bucket shops, where I don't think people realise you almost had like a stockbroker on every corner, didn't you? And it was this huge trading, and he was trading. People were trading on margin, weren't they? That's the key thing.
That is the key thing. But out of this book, you'll learn lots of things about trading, but he had a set of rules. And I thought today, these were just so poignant where we are now. Number one, avoid weak industries. And I thought, so we've seen, lots of consolidation in the pharmaceuticals. We've seen IT and the likes, So basically avoid the weak industries. Don't go bottom fishing in areas that are weak. Investigate before investing. Now, if you'd read the newspapers going into the Brexit or doom and gloom, the world is over. But the reality is, if you'd done your homework, maybe you would have come up with a different picture. Knowledge and patience. Only buy when you know they will go up. And again, sort of a lot of people gamble the stock markets, but I thought that was really good. Knowledge and patience. Only buy when you know they'll go up. So check out the conditions, maybe check out a chart, check out the fundamentals. The real news is not in the headlines. Seek it elsewhere. So you'll see a bumper headline, Bank of America calls the FTSE down to 5,000 on Brexit, and obviously it goes totally the other way. So ability to foresee conditions that will prevail in the future is absolutely essential. So try and look 6 months ahead, and Richard, you were always talking about the sort of longer term. okay, we get these short-term pullbacks, but should these be an opportunity to sell into or actually buy for the longer term? So the ability to foresee conditions that will prevail in the future is absolutely essential.
Richard, can a modern day investor learn anything from a 70-year-old book? It was a very different world back then, wasn't it?
But a lot of the principles are going to remain the same. Compound interest, for example, was certainly around, thousands of years ago, let alone a few decades. I think one thing it does do is crystallises the difference between traders and investors. Traders are important in terms of providing the market with liquidity.
Liquidity, yep.
But by their nature, they're taking short-term positions fine. In fact, by way of paraphrase, traders are renting the market. Investors are buying the market. They're in it for the long term. They can be a lot less active because they can have a simple old-fashioned buy and hold strategy. But underneath that, or rather before that step, that's absolutely right. You do your research first.
And I think as an investor, even if you plan to be a long-term buy and hold investor, you need to understand what traders are doing and what the trading game is about. And I think, the great thing about Reminiscences of a Stock Operator is it's a really easy book to read. It's a story.
Super
book. This is not a complicated investing book. Yep. This is a story. It's a really easy book to read, and it gets you inside that mindset of that person. It helps you to understand a little bit more about what's gone on over the last 10, 15 years, I think, in terms of, trading and the financial crisis and all those things. That book and The Intelligent Investor by Benjamin Graham, I'd say all investors should read those too.
Perhaps we'll cover that book next time.
Excellent. Well, join us after the break when we'll be speaking to Gemma Godfrey. See you then.